In this video, we will explore the U.S. stock market, its operations, significance, and various aspects that make it an attractive proposition for investors worldwide. So let's dive in. The U.S. stock market is widely regarded as the world's premier financial marketplace, and for good reason. It boasts the highest market capitalization globally and handles more transactions than any other financial center. But what exactly makes the U.S. stock market so appealing? One of the key factors driving the appeal of the U.S. stock market is its association with the world's largest and most innovative companies. From technology giants like Apple and Microsoft to financial institutions like J.P. Morgan and Berkshire Hathaway, the U.S. market provides exposure to some of the most prominent companies in the world. Many of these companies dominate their respective industries and have proven track records of innovation and growth. Moreover, the U.S. stock market is known for its liquidity, which refers to the ease with which investors can buy and sell securities. The sheer volume of trading activity that occurs daily in the U.S. markets ensures that investors can typically execute their trades without significantly impacting the prices they pay. This liquidity also provides a safety net for investors who need to sell their holdings quickly. Another aspect that enhances the appeal of the U.S. stock market is its type. Whether investors are interested in technology, healthcare, energy, consumer goods, or any other industry, the U.S. markets offer a wide range of options for diversification. The sheer size and depth of the market allow investors to create portfolios that spread risk across different sectors and company sizes, reducing vulnerability to any single investment. Furthermore, the regulatory environment in the U.S. contributes to the transparency and stability of the stock market. The Securities and Exchange Commission (SEC) plays a crucial role in protecting investors and maintaining fair trading practices. The SEC requires publicly traded companies to disclose their financial information, ensuring that investors have access to essential data for making informed decisions. Additionally, the SEC enforces regulations aimed at preventing insider trading, market manipulation, and other fraudulent activities, fostering a level playing field for all market participants. Lastly, the long-term performance of the U.S. stock market is a testament to its enduring appeal. Historically, stocks have outperformed other asset classes, such as bonds and cash, over the long term. The S&P 500, a benchmark index that tracks the performance of 500 large companies in the U.S., has delivered impressive returns since its inception. While short-term fluctuations are common, the overall trend of the market has been upward, attracting investors seeking long-term growth. There are several prominent exchanges where trading takes place in the U.S. stock market. However, to stand out as the most prominent, the New York Stock Exchange, NYSE, and Nasdaq, the New York Stock Exchange, often referred to as the NYSE, is the largest stock exchange in the world based on market capitalization. It was established in 1792 and has played a pivotal role in the development of the U.S. economy. The NYSE is home to many of the most recognizable companies in the world, including those in the Dow Jones Industrial Average. The exchange operates electronically, enabling fast and efficient trade execution. On the other hand, Nasdaq is known for its association with technology companies. It is the home of many of the most innovative and fastest-growing companies in the world, including Apple, Microsoft, Amazon, and Google. Nasdaq was the world's first electronic stock exchange and is famous for its iconic colorful display of stock quotes in Times Square. How does one invest in the U.S. stock market? Well, there are multiple avenues to gain exposure. One way is through individual stocks, which involves purchasing shares of ownership in a particular company. Another approach is investing in exchange-traded funds. ETFs provide instant diversification as they typically hold hundreds of stocks. Additionally, Mutual funds are a popular choice, allowing investors to pool their money with others to invest in a diversified portfolio managed by professionals. For those seeking options, contracts that provide leverage, or hedging opportunities, the U.S. stock market offers a variety of derivatives. Moreover, American Depositary Receipts, ADRs, enabled investors to buy shares of foreign companies listed on U.S. exchanges, expanding their investment horizons beyond U.S. borders. Lastly, investing in real estate investment trusts, REITs, provides exposure to the property market without directly owning real estate. REITs invest in income-generating properties and are required to distribute a significant portion of their income to shareholders. Now let's talk about the prominent indexes that serve as benchmarks for the U.S. stock market. Some notable ones include the Dow Jones Industrial Average, the S&P 500, the Nasdaq Composite, and the Russell 2000. Each index represents a different segment of the market and provides investors with various perspectives on its performance. The DJIA, established in 1896, is a price-weighted index that tracks 30 large, well-established companies. Although it covers only a small portion of the overall market, the DJIA is widely recognized and often used as a general indicator of the stock market's health. On the other hand, the S&P 500 is a market cap-weighted index that includes 500 of the largest companies in the U.S. By market capitalization, it is generally considered the best representation of the overall U.S. stock market and a benchmark for investment funds. The S&P 500 has a longer history than the DJIA, dating back to 1923. The Nasdaq Composite, created in 1971, is a market cap-weighted index that includes all Nasdaq-listed stocks. Given its heavy concentration in technology companies, the Nasdaq Composite is particularly sensitive to changes in the technology sector and often reflects the latest market trends. Lastly, the Russell 2000 is an index that tracks the performance of 2,000 small-cap companies in the U.S. These smaller companies tend to be more volatile than large-cap stocks, but they also have the potential for higher growth. The Russell 2000 provides insights into the broader U.S. economy and the performance of small businesses. To participate in the stock market, one needs to open an account with a brokerage firm. A brokerage firm acts as an intermediary, allowing investors to buy and sell securities. There are numerous brokerage firms available, each offering different services and fees. Some popular choices include Charles Schwab, Fidelity, and TD. Investors should consider factors such as the range of investment options, trading fees, and the user-friendliness of the brokerage platform when choosing a provider. When it comes to the mechanics of buying and selling stocks, it's important to understand the process. Once you've opened an account with a brokerage firm, you can place an order specifying the stock you want to buy or sell and the number of shares. The order is then executed on a stock exchange where buyers and sellers come together to trade. The entire process happens electronically in a matter of seconds. Yes, investing in the U.S. stock market carries risks. One risk is market volatility, which refers to the ups and downs of stock prices. The stock market is influenced by a wide range of factors, including economic conditions, interest rates, and investor sentiment. These factors can cause stock prices to fluctuate rapidly, leading to potential losses for investors. Another risk to consider is the impact of economic cycles. During recessions or economic downturns, businesses may experience reduced earnings, which can result in lower stock prices. Additionally, changes in government policies, inflation, and geopolitical events can also affect the stock market and pose risks to investors. Moreover, currency risk is a concern for international investors. The value of U.S. stocks is typically denominated in U.S. dollars. Fluctuations in exchange rates can impact the returns for investors holding different currencies. Lastly, behavioral pitfalls are a significant risk for investors. Emotional decision-making, such as panic selling or chasing hot stocks, often leads to suboptimal investment choices and can undermine long-term goals. Overall, while the U.S. stock market offers tremendous potential, it's crucial for investors to be aware of these risks and take appropriate measures to mitigate them. Diversification, a long-term perspective, and a disciplined investment strategy can help investors navigate market volatility and position themselves for long-term success. Absolutely. U.S. stock market has evolved significantly over the years. Technological advancements have played a pivotal role in this. Online brokerage platforms have democratized investing by providing easy-to-use interfaces and commission-free trading. Robo-advisors have emerged, offering automated portfolio management using algorithms and big data. Artificial intelligence is employed for predictive analytics and risk management. Moreover, blockchain and tokenization are gaining traction, potentially transforming equity ownership and settlement systems. Thank you for joining us on this comprehensive exploration of the U.S. stock market. We've delved into its historical context, structure, key players, and the factors that contribute to its global appeal. If you found this video informative and would like to stay up to date with our latest content, please don't forget to subscribe and hit the like button. Your engagement is valuable, and we look forward to bringing you more insightful content in the future.